The housing crash theory is back. And this time, it's not just your uncle at Thanksgiving who watches too much YouTube. It's headlines. It's TikTok threads. It's finance Twitter doomscrolling at 2 in the morning. Everyone's convinced we're one bad jobs report away from another 2008-style meltdown where home prices crater, foreclosures flood the market, and suddenly, everyone who bought at the peak is underwater and panicking. The narrative is everywhere. Housing is unaffordable. Mortgage rates are stuck in the sixes. Nobody's buying, nobody's selling, and the whole thing feels like it's teetering on the edge of something ugly. So naturally, people are dusting off their old crash playbooks and getting ready for the sequel. But here's the problem. The story everyone's telling is half right and half fantasy. Because yes, this market is broken in a lot of ways, but it's not broken in the same ways it was in 2008. And if you're waiting for a nationwide price collapse, where every market tanks 20% overnight, you're probably going to be disappointed. Because what we're actually looking at is something way less cinematic and way more frustrating. A slow, grinding stagnation with cracks forming in specific places while other markets stay weirdly resilient. And understanding the difference between those two outcomes matters a lot more than just predicting whether prices go up or down. So let's start with why people think the crash is coming. Because on the surface, the case writes itself. Mortgage rates as of late March were sitting at 6.38% for a 30-year fixed loan. That's not catastrophic by historical standards. But it's more than double what rates were just a few years ago. And for most buyers, that difference is brutal. A house that would have cost you $1,500 a month in 2021 now costs over $2,000 for the same loan amount. That's not a small bump. That's a whole car payment. And it's not like wages magically doubled to keep up. So affordability is in the gutter. The median existing home price in February sat at $398,000. That's up slightly from a year earlier, but the bigger issue is that prices haven't corrected enough to offset the rate shock, so buyers are stuck. They're looking at the same expensive houses they couldn't afford a year ago, except now the monthly payment is even worse. The math just doesn't work for a huge portion of potential buyers who might have qualified 3 years ago, but now find themselves priced out entirely. And predictably, they're walking away. Existing home sales in February were running at about 4.09 million units on an annualized basis. That's up slightly from January, but it's still down from the year before. And more importantly, it's way below the normal pace of home sales we saw before the pandemic. The market is moving in slow motion. People aren't panic selling, but they're not exactly lining up to buy either. And then there's inventory. This is where the crash narrative really picks up steam. Because in February, there were about 1.29 million existing homes for sale. That's a 3.8-month supply, which is still technically low by historical standards. But here's the thing. Inventory has been rising. Slowly, unevenly, but rising. And in certain markets, especially at the higher end and in some Sunbelt cities that overheated during the pandemic, listings are starting to pile up. Homes are sitting longer. Price cuts are becoming more common. And sellers who thought they could name their price are realizing the market isn't what it was 2 years ago. You're seeing houses that used to get 10 offers in a weekend now, sitting for 60 days with maybe 1 or 2 showings. So if you squint, it starts to look like the beginning of something bigger. Like maybe this is the part in the movie where the cracks appear before everything collapses. And it's not just existing homes. New home sales are getting hammered too. In January, new home sales were running at a 587,000 unit pace. That's down over 17% from December and down more than 11% from the prior January. Builders are pulling back, and they're sitting on a lot of unsold inventory. In January, there were 476,000 new homes for sale, which works out to a 9.7-month supply. That's a lot. And the median price for a new home dropped to $400,500, down almost 7% from a year earlier. So builders are cutting prices to move product, which is exactly the kind of thing that makes people nervous. Because if the guys actually building the houses are slashing prices, what does that say about where the market is headed? And it's not just price cuts. Builders are throwing incentives at buyers under rate buy-downs, upgraded appliances, paid closing costs. They're doing whatever it takes to get deals across the finish line. When builders get desperate, it usually means something's shifting. Then you layer on the consumer side of the equation. Household debt hit $18.8 trillion in the fourth quarter of last year. Mortgage balances alone reached $13.17 trillion. And even though mortgage origination activity picked up slightly with over $500 billion in new mortgage debt that quarter, a lot of that was just people refinancing or tapping equity. It wasn't a wave of new buyers entering the market. It was existing homeowners trying to manage their balance sheets. And when you combine high debt levels with high interest rates and flat wage growth, you get a consumer base that's stretched thin. Our people are maxing out credit cards, falling behind on car loans, and generally running out of room to maneuver. So the argument goes, if consumers are this fragile and housing is this unaffordable, how long before something breaks? And honestly, it's a reasonable question. But here's where the 2008 comparison falls apart. Because the crash everyone remembers wasn't just about high prices or weak demand. It was about a systemic collapse in credit quality. Back then, you could get a no-doc loan with no job, no income, no assets, and somehow walk away with a $500,000 mortgage. Lending standards were a joke. Subprime loans were bundled into securities and sold as safe investments. And when people started defaulting, the whole house of cards came down. Foreclosures flooded the market, prices tanked, and the financial system nearly imploded. That was a crisis driven by leverage, fraud, and reckless lending. This is not that. Not even close. Underwriting today is tight. You need documentation. You need a real down payment. You need proof of income and a decent credit score. The loans being originated now are boring and safe. Default rates are low. Foreclosures are rare. And the borrowers who do own homes are sitting on a ton of equity because prices have been rising for over a decade. So even if someone gets into trouble, they're way more likely to sell and walk away with cash than to just hand the keys back to the bank. There's no wave of distressed inventory waiting to hit the market because most homeowners are in pretty good shape financially. They're just stuck. And that's the key word. Stuck. Because here's the other thing nobody talks about. A huge chunk of homeowners refinanced into sub 3% mortgages during the pandemic. And those people are not moving unless they absolutely have to. Why would you give up a 2.75% rate to go buy a new house at 6.4? You wouldn't. So inventory stays low. Turnover stays low. And the market just kind of freezes. You've got people who want to move but can't afford to. You've got buyers who want to buy but can't afford the payment. And you've got sellers who want to sell but can't find anything to buy afterward. It's gridlock. This creates a weird prisoner's dilemma where everyone's waiting for someone else to blink first. And gridlock doesn't lead to a crash. It leads to stagnation. And it leads to a market where transaction volume collapses, but prices don't because nobody's forced to sell. That locked-in effect is probably the single biggest reason this market can't crash the way people expect it to. Now, does that mean prices can't fall? No, they absolutely can. And in some markets, they already are. But it's not happening everywhere at once. The markets that are cracking first are the ones that ran up the hardest during the pandemic. Places like Austin, Boise, Phoenix, parts of Florida. These are cities where prices doubled in 2 years, where everyone and their dog moved during remote work fever, and where builders went crazy throwing up new subdivisions. Now demand has cooled, inventory is rising, and prices are softening. In some cases, they're down 5, 10, even 15% from the peak. That's real. That's painful if you bought at the top, but it's also localized. It's not a nationwide collapse. It's a regional correction in markets that overheated. And the pain is concentrated in specific price tiers too. Luxury homes and new construction are getting hit harder than starter homes, which still have more buyers competing for limited supply. Meanwhile, other markets are holding up fine. Places with strong job growth, limited land, and tight supply constraints aren't seeing big price drops. They're seeing slower appreciation. The Case-Shiller National Index posted a 0.9% annual gain in January. That's down from 1.1% the prior month. So yes, price growth is slowing, but it's still growth. It's not a crash. It's deceleration. And the FHFA reported that U.S. summer house prices rose 0.6% in November from October and were up 1.9% year over year. Again, slow growth, not collapse. The national numbers mask enormous regional variation. If you're in San Francisco or Seattle, your market looks totally different than if you're in Tampa or Austin. So what does all this actually mean? It means we're in this weird, frustrating middle ground where the market isn't healthy, but it's also not imploding. Prices are too high for most buyers. Rates are too high for most borrowers, but supply is too low for prices to crater. And credit quality is too strong for a wave of defaults. It's a standoff, and standoffs don't resolve quickly. They drag out. They create frustration. They create regional winners and losers. But they don't create nationwide crashes. They create markets where nothing happens for years. The real risk here isn't a sudden collapse. It's a slow grind where affordability stays terrible, transaction volume stays depressed, and the market just kind of limps along for years, where some markets crack and others stay flat, where homeownership becomes even more out of reach for younger buyers, where the wealth gap between people who own homes and people who don't just keeps widening. That's not dramatic. It doesn't make for good headlines, but it's way more likely than a repeat of 2008. And here's the thing about stagnation that makes it insidious. At least a crash forces a reset. It clears out excess. It creates opportunity eventually. Stagnation just locks everything in place. It preserves all the existing inequalities and makes them permanent. And here's the uncomfortable truth nobody wants to hear. A lot of people are rooting for a crash because they think it's their only shot at buying a house. And I get it. If you've been priced out for years, watching prices refuse to fall is maddening. But a real crash doesn't just make houses cheaper. It comes with job losses, credit crunches, and economic pain that makes it even harder to buy. The people who benefit from crashes are usually the ones with cash and stable income, not the ones barely scraping by hoping for a deal. So be careful what you wish for, because the conditions that create a housing crash are the same conditions that destroy your ability to qualify for a mortgage. The bigger macro picture also matters. Mortgage rates aren't falling anytime soon unless something breaks in the economy. The Fed has talked about cutting rates, but long-term mortgage rates don't just follow the Fed. They follow the bond market. And the bond market is dealing with massive government deficits, inflationary pressures, and global capital flows that are way more complicated than just what Jerome Powell says at a press conference. So if you're waiting for rates to drop back to 3%, you're probably going to be waiting a long time. And if rates stay elevated, affordability stays bad. And if affordability stays bad, transaction volume stays low. And if transaction volume stays low, the market stays frozen. So where does that leave us? It leaves us in a market that's broken, but not collapsing. A market where some people will get hurt, especially if they bought at the peak in the wrong place. But it's not 2008. It's not a systemic meltdown. It's a slow, uneven, frustrating slog where the biggest risk isn't a crash. It's that nothing changes. Prices stay high. Rates stay high. Inventory stays low. And the dream of home ownership drifts further out of reach for millions of people. That's not a crash. That's just a different kind of failure. And honestly, it might be worse.